Hello, everybody. This is Bennett Tchaikovsky, and this is my take 3 on part 3 of Intermediate Accounting, Wiley Chapter 5, Present Value. So let's go ahead and take a look at this one here. My disclaimer and copyright notice: the information and opinions in this presentation are those of myself, the author, and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University at Fullerton. The presentation is for educational purposes only. It does not constitute any legal or accounting advice whatsoever. This video is meant to be a companion to the 18th edition of Intermediate Accounting by authors Don Kiso, Jerry Weingan, and Terry Warfield, which is copyright 2022 by Wiley. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay, so hello everybody, and so let's go ahead and take a look. So this one, I'm not using Wiley's for this series. I'm not using Wiley's PowerPoint slides. Those belong to them. Rather, what I'm doing is I'm either going through problems like what I'm going to be doing today, or I'm going to be going through and looking at sec.gov. I would suggest watching this video prior to going through the problem walkthroughs that I've previously created. And let's go ahead and go to it. So this is the last part of the video, thank goodness. The first one is a revisiting of bonds payable, just to kind of get us used to the present value of a dollar table and the present value of an annuity of a dollar. And then the next part of it is imputing interest, because if we have a zero interest bearing note, essentially this is from accounting tools. I've used them before a few times, but they do a great job. What is imputed interest? It's basically is the estimated interest rate on debt rather than the rate contained within the debt agreement. So if there's zero interest bearing, we have to go through and impute interest. So that's really what we're going through and doing here. So now we're going to have some fun with some payments, right? So we're selling equipment, PAE, which is the Everett Airport, by the way, very nice. So check it out. Sells equipment to S&A on January 1st, 2026. The equipment cost PAE $100,000 and had accumulated depreciation of $25,000. S&A will make the four $30,000 payments to PAE on 12/31/26, 12/31/27, 12/31/28, and December 31st, 2029. The interest rate for similar notes is 10%. So the first thing you have to do is to say, okay, if they're just buying it and they're giving us, okay, we're going to give you $30,000 a year for the next 4 years, that doesn't cut it, because the payment, the equipment that we're selling today is not comparable to those future dollars coming through. So what we're going to do is, first thing is, whenever we sell equipment, how do we go through and write the journal entry? We're going to go ahead and debit accumulated depreciation, because we have to take that off of our books. We're going to credit equipment for $100,000, and this is going to be for 25. Now, normally I would write notes receivable for 120,000, and then we would be done. Well, if this note receivable is being paid in like a month or two, that would be very, very different, but in fact, it is not. So what we have to go through and do is to basically present value these payments back into today's dollars. Now, unlike this 120 is not coming all at once, it's coming 4 times at $30,000 each time. So what I have to do is I have to take the payment amount. The payment is $30,000. I'm going to go to the present value of an ordinary annuity of a dollar, and I need to know 2 things. First one is going to be how many times are the payments being made. So this is going to be 4 periods at 10%, which is the market rate of interest. Okay, so when I come over here and I take a look at this, present value of an annuity of a dollar, 4 periods at 10% is 3.16987. I'm going to come back over here. And so the value of this in today's dollars is approximately $95,096.10. Okay, so the net amount, or the net carrying value of the note, so if the note receivable is here at 120, and if this is really worth in today's dollars is 95,096.10. I'm going to need to have a discount of 24,903. Okay. Let's make sure I got that right. 3.16987. Perfect. Okay. So we've got that part settled. Okay. So my discount on note receivable is going to be over here at 24,900. Let's call it 24,904. Okay. Now is my journal entry balance, right? So this is going to be to record sale of equipment. Well, I've got a problem over here. I've got debits of 145, credits of 124,904, or a difference here of 20,096. So over here, the 20,096 is going to be my gain on sale of equipment. Okay. All right. So this is if I'm selling equipment, like what we're going ahead and doing right over here. So here we go. So we've got the initial journal entry done. So let's just talk about this a little bit. So the discount on notes receivable, as we kind of saw from the part 2 of the video series, is this is really a holding account for interest revenue. So the value of that note is not 120, it's 95,096. So the difference between the 120 and this amount is really representing interest revenue, which I will be recognizing over time. So what's going to happen and what's kind of the best way to kind of approach these questions when we have payments? I would kind of go through and suggest to you the best way to kind of to look at this is let's write out what we know. Well, every single year on 12/31/26, and then the following year, okay. So every single year, I'm going to be receiving cash and I'm going to be crediting the note receivable, right? Every year, I'm going to get 30 grand. And then over here, I'm also going to be receiving, it's going to reduce the amount, the carrying amount of the note by 30,000. Okay. So over here, I'm going to go through and do this approximately 4 times. Now, where the challenge comes in is, well, this is to record payment received on the note. The challenge comes in is that when I look at this discount on note receivable, which is presently sitting at, it's a contra asset account, basically the discount on notes receivable, this presently has a credit balance of 24,094. By the end of the notes term, this has to have a balance of 0. So I need to take this in and recognize this over here to interest expense. And if we look at the note receivable, what does that kind of look like? So my note receivable, 120,000. I'm going to get 30 grand on 12/31/26. The balance of this will be 90,000. That's going to be my first one, the first payment that comes through. I'm going to get another payment of 30,000 on 12/31/27. This balance over here is now going to be 60,000. I'm going to get another 30,000 over here on 12/31/28. This balance over here is also going to be another 30,000. Okay, so over here, 30,000, 12/31/29. And now we're going to get out down over here to a 0 balance, right? So it's going to basically have a 0 balance at the very end of the day. And let's undo that. Okay. So let's just kind of keep this in mind. And why is this so important is because as we're going through and trying to determine how much interest revenue we're going to recognize, we want to know that the value of this note is going to be going through and changing, right? So over here, right? So as I make these payments every single year, the carrying value of the note is going to be dropping. So in order to make this discount on notes receivable go down to zero, I'm going to have a debit to discount on notes receivable, and I'm going to be crediting interest revenue. Okay, so how do I go through and record this? Okay, so let's go through and try to figure this out. The interest revenue is always going to be based on the carrying value of the note. So here in year one, which is 2026, so over here, my note payable, right? The very first part of this over here is going to have a value of 120,000. It's basically what it came out to be when I first started in my discount on the note payable. Or excuse me, on the note receivable. My note receivable, okay, my discount on note receivable is going to be 24,904. So my note receivable carrying value is going to be 120 minus 24,904. I'm going to take the note receivable carrying value. I'm going to multiply that by my interest rate. So my interest rate is at 10% because the 10% is what I went through and used to go through and to amortize this. Okay, so this is going to be my interest rate down over here. So this is going to give me my interest revenue. So my interest revenue over here for year one is going to be 9,510. So when I record this, and this is going to again be in for the end of 2026, I'm going to credit interest revenue. I'm going to go ahead and debit the discount on notes receivable. So when I do this, my ending balance on the discount of notes receivable is going to be 15,394. So let's go to the second year. Second year, my notes receivable, though, is no longer 120. I made a $30,000 payment, so now it's going to be 90,000, or basically right over here, right? So I made a payment. So after I make that payment, it's now down to 90,000. Okay, so my discount on notes receivable is no longer 24. It's now 15,394. So my carrying value of my note receivable is 74,606. My interest revenue is going to be over here at 7,461. Okay, so as I come over here, my note receivable is going to be debited for 7,461, crediting interest revenue for 7,461. That's going to come over here. And so now my unamortized discount on note receivable is going to be at 7,934. I come over here to my next year, and in the next year, well, my note receivable is no longer 90,000. It's now going to be 60,000. My discount on notes receivable is no longer 15. It's now 7,934. My carrying value of my note receivable is going to be 52,066. My interest rate is at 1%. So my interest revenue is going to be 5,207. Okay, so over here, so my ending balance on my discount on note receivable is going to be over here at 2,727. So third year, last year here, right? What happens? 30 grand, right? So once this payment's been made, the remaining balance is 30,000. My unamortized discount is 2,727. My note receivable carrying value is going to be 27,273. Interest rate is at 1%. So over here, my interest revenue is 2,727. And by gosh, we've hit a miracle. This has gone down to zero. And so I have gone through and done my job, which is fully amortizing the discount. Now, this is the fun part. When I was going through and doing this question, well, I was having trouble because like the fourth time I've done this video, it happens from time to time. But if I asked a student, if I said, okay, what is the balance sheet presentation as of 12/31/26 after the payment was made, after the 30,000 payment was made? Okay, so this is a tough question. Why is it tough? Well, when I look at a balance sheet, right, when we're looking at a balance sheet, what we have to kind of think about is the classification or the categorization of assets and liabilities. So over here, if I go to Apple, right, if we go to Apple and we look at their balance sheet, you're going to see over here, current, non-current. What do those mean? Current means I'm going to use it in the, or basically get the benefit from it in the current year. Non-current is basically going to be beyond a year. So if I were to do this and I look at this 90,000, right? So the total amount that's owed after this first payment is made is 90 grand. So on my assets, I'm going to have current assets, note receivable is going to be 30,000. Non-current assets, note receivable is going to be 60,000. Why is it like this? Because of this 90, 30,000 is due in the coming year, and the remaining amount is going to be due beyond the year. Okay, so when I look at this over here for on my balance sheet presentation, the larger amounts are going to be, due in these next periods. Okay, so now here's the fun part. Now for this part over here, the amount of the discount that that's going to be associated with this 30,000 less discount on notes receivable is going to be this basically 7,461. So my notes receivable net would be over here at 22,539. On the 60,000, and even as I'm saying that right now, I don't think that that's right, because if I were really to go through and to do this, that is not correct, because that is for all 90,000. So what I would need to do is I would have to take a third of this amount. So I would take a third. Oh, brother. So I go over here. So discount on notes receivable. And this is why I'm not, if you're in my class and you're seeing this, I'm just doing this more for fun. Sounds like a weird way to have fun, but why not? 7,461 divided by 3 is 2,487. So the note receivable net current is going to be 27,513. The notes receivable non-current is going to be my discount on notes receivable, which is going to have two components. It's basically going to have 7,461 times 2/3 plus these two numbers here, these last amounts that need to be amortized out. Okay, so then this would give me notes receivable net. I might have to do this video a third time. So my total amount of notes receivable, right? If I basically, so my current portion would be here, non-current would be here. And again, where am I getting this 12,908 from? Well, in the future, I'm going to be amortizing this over here. This is going to be, this 12,908 is going to be 2,727, which is the 2029 amortization. This would be over here, the 5,207, which is the 2028 amortization. And then you got to take this amount here and basically multiply it by 2/3, which is the 2027 amortization that relates to the 60 grand. So this over here is going to be 7,461 times 2/3, the 2,487. This is 7,641 times 1/3, right? Why am I doing it this way? Because it's 30,000 of the 90 of this amount, 30,000 of this amount. Basically, it's relating to 90,000 of the debt. And so because only 1/3 of that debt is going to be due in the coming year, that's where we're getting that number from. Okay. When I add these up, I get 12,907, 2,487. And then when I look at these discounts in aggregate, this is going to be 15,394, which is the number we have right over here. So we have to basically take that discount and split it up. But this is why, if you're taking my intermediate accounting class during the very first semester, I'm probably not going to have you go through and do this. So, but that's how to be technically correct. And by the way, going back to my first video on present valuing with a bond, you probably would have to go through and do the same thing for the upcoming interest payments. I think from an accounting standpoint, I said, well, we're just going to assume that it's all going to be non-current. Okay. So wasn't that a treasure? Why did I have to go through and do this? Because current means that it's going to be due, or we're going to be receiving it in the coming year. Non-current is beyond a year. So you'd have to go through and do this calculation. Okay, let's keep going. Now, over here, as we kind of saw, we're going to do the same thing. Isn't this fun? This is like exciting. Like I can't make enough of these videos. It's always a good time. Okay. So now over here, I'm pretty much doing the same deal, but I'm now going to be doing this from the perspective of purchasing the equipment. So when I'm buying the equipment, the way I'm going to go through and do this on 1/1/26, the way I'm going to go through and purchase the equipment is I'm going to say, okay, I've got I'm giving PAE a note payable for 120,000. And I'm going to have a discount on the note payable because that is not in today's dollars. It's going to be 120,000 minus 95,096. And then over here, I'm going to have my equipment at 95,096, and this is going to be the record purchase of equipment. Okay, so we're now doing this from the other side. Over here, we'll be going through now and taking a look at this. Okay, so let's do the same thing. What happens every single year? Well, every single year, I'm going to be debiting notes payable and crediting cash for 30,000, right? Because I have to make payments of 30,000 every single year for the next 4 years. Okay, so let's go through and do that part. Okay, so to record payments on note payable. Okay, now let's take a look at what our balance sheet looks like right now. So we're going to have this note payable. The note payable is a liability account, so it's going to have a credit balance. This is going to be at 120,000. Okay, so for this 120,000, this is going to be as of 1/1/26. I pay 30,000 on 12/31/26. So at the end of the year, my note payable balance is now going to be 90,000. Pay 30,000, and then on 12/31/27, my ending balance of note payable after I make that payment is now going to be 60,000. Got another 30,000 over here. So this is 12/31/27. On 12/31/28, I make another payment. So my ending balance on 12/31/28 after I make the payment is going to be $30,000. Make another $30,000 payment. And so I will owe 0 on this note as of 12/31/29. So when I come over here and look at my note, right? So this is what's happening every single year. So, and for my discount on note payable, this is what I have to amortize. The discount on note payable is a contra liability account. So my discount on notes payable is right over here at $24,094. I have to make this go down to 0. Okay, because again, this is just another way of saying that this really represents interest expense. So what I have to do is I'm going to have to credit the discount on notes payable. And I'm going to debit interest expense. Okay, so to go through and to do this part over here, how much do I amortize my discount by? Okay, so over here, year 1, year 2, year 3, year 4. So prepayment, my note payable was $120,000. And over here, less my discount. My discount on notes payable out the gate was $24,904. Coming over here, this is going to give me a note payable carrying value. So my note payable carrying value is $95,096. My interest rate is always the interest rate I use to go through and to discount the note. So my interest expense is going to be $9,509.60. Okay. So over here, I go ahead and credit discount on note payable. I'm going to go over here and debit interest expense. And then I'm going to go ahead and basically credit the discount on notes payable. Now, sometimes people will ask me, well, Bennett, why aren't you doing a T account for interest expense? Just remember that interest expense, all expenses, revenues, and dividends are temporary accounts, so they're going to be closed out at the end of the year. Discount on notes payable is a contra liability account, so it is not going to be closed out to retained earnings, and that's why we leave it over here separate. Okay, so my discount on notes payable at the end of the year at 12/31/26 after the payments made is $15,394. My note payable for the following year is no longer $120. Why? Because I went through and I made a $30,000 payment. My discount on notes payable over here is going to be $15,394.40. Okay, so my note payable carrying value is $74,606 at 10% interest. My interest expense is now going to be $7,461, which is also going to be that amount that I'm going to be amortizing my discount by. So at the end of the second year, this over here is now going to have a balance on 12/31/27 of $7,934. Go to the next year. Note payable no longer 90. I made another payment. This is going to be 60,000. The discount on notes payable, 7,934. My carrying value is 52,066. My interest rate is 10%. Over here, I've got 5,207. So I'm going to amortize that discount by 5,207 by taking it to interest expense. So right over here, this is going to be for 12/31/28. And my ending balance and my discount should now be 27/27, 12/31/28. Go to my last year, just made another payment of 30,000. So there's a $30,000 remaining balance. My discount on notes payable unamortized is 2,727. So my carrying value is 2,273. My interest expense is going to be over here at 2727. And so I've done my job because this now comes in and basically gets me down to 0. So that's how we do this type of question. And because of the complications of this, if you're taking one of my classes, I probably wouldn't ask this unless you had something on Excel. But that's how you'd have to go through and show it, because you have to bifurcate it, because it's current versus non-current. If this is a liability, it would look the same exact way. It'd be note payable less the discount on note payable, and you'd have to separate it between current and non-current assets. So more fun for all of us. So anyways, hey, I want to thank, and by the way, this isn't even technically correct, because you could even, I don't know. I think that's right. So, but we'll see. I made this thing up myself, so there's no way to go for me to go through and check anything. But hey, there you go. I want to thank you for joining me on today's Accounting Odyssey 101. Please don't forget to like and subscribe to the channel. If you have any questions, feel free to email me at 1812cpa@gmail.com. I look forward to seeing you on the next video. Have a great day.